So we are finding out operating ROA, operating return on assets. What do you mean by operating return on assets? See, let's say, first of all, what is EBIT? EBIT is also called as operating income or income from operations. How you get this EBIT? Sales minus COGS. You get gross profit. From that, when you remove operating, administration and selling expenses, okay, you get EBIT, earning before interest and tax. That is also called as operating income. So this is very relevant for a company or for a business. Why? Because this is the income what we generate from our operations. And if we get this income, we can definitely pay our certain expenses which are of non-operating nature or finance nature, like interest. So before making the interest payments, the income or the profit what you have generated is what is called as operating income or operating profit or EBIT. So what we are seeing, if we have invested $100,000 and we've got a EBIT of, let's say, $10,000, it means for $1 investment in assets, we have generated 10 cents of operating income. Previous year, if we have generated 8 cents of operating income, that means this year is a better year. That's it. Then comes return on invested capital. See, when you say return on invested capital, there are many investors who would invest their surplus money in a company by way of providing finance to that company, either in form of debt or in form of equity. So if this is a balance sheet, statement of financial position, you have total of assets, which is current assets and fixed assets together. And then this is called the asset side. This is called the liabilities and equity side. Not only liabilities, it is liability and equity. Equity is nothing but capital. So under equity, what you take? So total capital includes short and long-term debt, preferred equity, that is preference shares, and common equity. That means if a company is raising funds in form of equity shares or equity by selling equity shares of the company or equity share capital, that's called common equity. So I'll take equity capital. If a company, it's not necessary that company should be raising funds only through equity capital. It can be a combination of funding what they are raising, or it can be the capital can be in combination, or different source of finances can be opted for arranging capital for the business. So in amongst them, equity capital is one, then preferred equity or preferred capital is one, and debt finance, that is long term loans we say, or bonds. Company can issue bonds to public and raise their funds. And apart from that, we are also taking short term loans. So we are taking all the kind of debts. We are not considering all the current liabilities like payables or outstanding expenses. We are not taking all this, but we are taking every kind of loan, whether it is a long-term loan or short-term loan or equity capital or preferred capital. So when you take all of them, definitely every investor would like to know what is their return from the investment what they have done. Since this is a particular ratio which tells us for all the types of finances, whatever the investment have been done, what is the return the investors are generating. Okay, so why are we taking EBIT here? Bhargav, can you give me an idea why are we taking EBIT? Why are we not taking earnings after tax or net income, please?
So
Hello.
we are taking EBIT because we want to
We want to.
calculate the income from operations only in respect to the total capital. And if we deduct the interest amount and that, we will get the net profit, which will not take into consideration the debt capital or the interest paid on that.
Very good. So since you know the total capital is having debt finance in it, henceforth The interest is the reward what the bondholders or the lenders of the company want for the money what they have lent to the company. See, you are investing your money, your investment, what you're doing for some particular return for that, right? See, why are you investing your money? Definitely for some returns. So why people, then you'll be asking a question, sir, why don't everyone buy the equity shares? Why people buy the bonds of company? Because bond is a very safe investment. Equity is a very risky investment. Not everyone in the world would like to take risks because people have different risk appetites. You should be knowing that. So since the interest has to be paid and that can only be paid from operating income or EBIT, we consider EBIT in the numerator. Okay. So here, Umayya, did you understand? Just give me an answer for this. Did you understand this? Yes or no? Hello. Umayya, I'm asking you, did you understand the concept? Why are we taking EBIT in the numerator? Hello. Hello. Isha, did you understand what I'm saying?
Yes, sir.
Okay. Just a second. Okay, so this is what is about EBIT, why we are considering EBIT or taking EBIT. So EBIT by average total capital. Let's say our EBIT is, let's say, $10,000. Same concept is applicable and total capital, average total capital is $100,000. That means for an investment of $1, we are making 10 cents. Okay. And if we got 8 cents previous for $1, like if we compare these two, $1.10 is better than $1.08, right? Next comes ROE, return on equity. So this is only from the perspective of equity holders, equity shareholders of the company. So how you will find the net income for no, sorry. When so here we are taking return on equity, there are two things, two ratios here. I will show the difference to you because next question you are going to calculate a lot of ratios. I'm going to give you the question to solve. So it will be a reference. It will be a kind of refresher for you. So it is return on equity and as well as return on common equity. What's the difference between return on equity and return on common equity? Equity can have two types of equities. One is preferred equity, one is common equity. Preferred equity is called preference shares or preference share capital, and common equity is called common shares or common share capital. Okay, or equity share capital, whatever you want, you can say. So in equity, if I tell just equity, that means I'm generalizing the types of capital what I want. So what types of what comes under equity? What comes under equity is common equity and preferred equity. That means equity share capital and preference share capital. What comes under common equity? Only equity share capital. Okay, so here preference share capital and equity share capital both comes. Here only equity share capital comes. Okay, so the formula here would be net income by average, so total equity, average total equity, average total equity. That means net income, if it is $10,000, average total equity is nothing but you can take opening preferred stock plus opening preferred share capital plus opening equity share capital. Okay. Okay, this two. That means opening balances of this two plus closing preferred share capital and closing equity share capital. The closing balances of this two whole divided by 2. So opening capital plus closing capital divided by 2 would give you average total equity. Average is nothing but sum of the observations by number of observations. So here there are two observations, like opening balance and closing balance, both are given. If they don't give you opening balance and only give you closing balance, only you can take closing balance and don't divide by 2, because the formula for average is opening balance plus closing balance whole divided by 2. Okay, that is sum of the observations by number of observations. If you have only one observation, that you will take only one observation and you will be dividing by 1. Anything by 1 is the same number. Okay, or the same figure. Again, we are taking here equity share capital. So ROC, return on common equity, the formula is, here there is a change, net income minus preferred dividends. Why I am taking net income minus preferred dividends? Because I want to see or check the return for common equity holders only. So when I want to calculate ROC, that is return for common equity holders, I should only be taking the income which is available for common shareholders. Henceforth, from net income of the company, I will be removing the preferred dividends. Why I'll be removing? Because because equity holders happen to be the actual owners of the company, and after meeting all the obligations of the company, the final resultant figure, whatever is left over, is what belongs to common equity holders or actual owners. So the obligations what company has to meet is they have to settle all the expenses, they have to pay tax to the government of India, in expenses, all the operating expenses or non-operating expenses like interest, etc. So this they have to pay finance expenses because they have borrowed money from banks or from the public. They have to pay interest, they have to pay tax to the government, then afterwards they are left over with net profit, but again they have to pay preferred dividends if the company has also raised funds through preference share capital. So finally what is available is the profit attributable or available for common share holders, right? So that I am taking here. This is the profit which only belongs to common shareholders after removing the preference dividends, whole divided by average common equity. That means opening equity balance plus closing equity balance divided by 2. Both the ratios, the concept is same. For $1, 10 cents. Here also 10,000 is the amount which has to be given to the equity holder. See, every time I'm taking the same example because I want to make you understand the things very simply, because round figures are easy to understand. For $1, again, I'm earning 10 cents. And as I told you, whatever the profitability ratios I'm considering, they are not absolute measures. They're all relative measures. So when compared to previous year, if in previous year for $1, if I got 8 cents and this year I'm getting 10 cents, definitely this is a better performance, right? So this is what I've explained everything to you. Now there is a question in front of you. I want you to solve this question. That means you have to do all the ratios. You have to find out the current ratio. You have to find out the total asset turnover. You have to find out the net profit margin. You have to find out the return on common equity. You have to find out the debt to equity ratio. So I'll write all the ratios there. Can you find out and tell me right now, please? Hello.
Yes, sir.
You want to do it right now or you want to do as a homework?
Sir, we'll do it as a homework.
Your wish. If at all it's if you want to do as a homework, you can do that. No problem. Or else if you want to do it takes just 5 to 10 minutes. If you want, you can wind up right now. Anything. So Bhargav has said homework. Isha and Umayya. You want to do as a homework, you want to do it right now. Come on.
We'll do right now, sir.
You want to do it right now? Okay. So I'm giving you the data. So make it fast. The data is in front of you. Okay. You have to find out the current ratio, total asset turnover ratio, then net profit margin, return on common equity, net profit margin, return on common equity, and the last ratio is debt to equity. Debt to equity. Okay. So like all these ratios are in front of you. Fine. I understand that you can do as a homework. Come on, tell me the formulas for this. Tell me the formula for this, Bhargav. Total asset turnover ratio. Fast. Hello. Bhargav, are you hearing?
Yes, sir. Yes, sir.
Okay, fast. Don't turn the books. Have to say me.
Revenue by total assets.
Which revenue? Net revenue or gross revenue?
Net revenue.
Net revenue by average total assets if you have 2 years figures, right? What's the formula for ROC? Okay, this I've explained right
Net,
now. What's the form?
net
What's the form?
income
Yeah, net income.
minus preference dividend by
Yeah,
average equity.
average common equity. Good. Debt to equity ratio.
Total debt by total equity.
Very good. Current ratio CA by CL. Current assets by current liabilities, and net profit margin is net profit by revenue. Okay, come on, calculate fast and tell me the answers.
20.
You can take your calculator and just fast. You can just make it fast. I'll be back in 2 minutes. Do it. Yeah, have you finished?
Yes, sir.
Yeah, Bhargav, have you finished?
Yes, sir.
What's the answer for current ratio?
One.
Actually, we were not able to see current assets.
Okay, find out.
It's 1.9, sir.
Okay, I'm writing the answers. Have you seen the data? Hello?
Yes,
Yes.
sir.
Yeah, so have you seen the data? Okay. 1.9. Next one. What is the total asset turnover ratio?
2 times.
2.
Okay. What about the net profit margin?
5%.
Sorry?
5.
5%.
5%. What about the ROC?
Uh,
1.
0.19 times.
Uh,
0.19.
Sorry?
21.
21%. Okay. Okay. And what about the debt to equity ratio?
0.6 is to 1.
0.66?
0.6 is to 1.
0.6 is
No,
to
sir.
1. Okay, okay. No problem. You tell your answer.
I got 79.8. Like 80.
79.8. 80.
We have 3 debt, no, sir. 610, 160, and 55.
Current year.
Huh. 610,
610?
610, 160, 55. Up, up only, sir, 55. We added by this and
But in debt to equity, we usually consider only long-term debt, no, sir?
No,
it's
in total debt. Okay, let us see the answer. It will be revealed here. It is total debt, right?
Okay.
When you take total debt, it is long term, short term debts, and long term debts. Both you have to take. Okay. Hello.
Yes, sir.
Yeah, you can check current ratio, total asset turnover ratio, net profit margin, return on equity, common equity, and debt to equity. You can check it. I'll move forward. Should I move forward?
yes, sir.
Relationships among ratios. So an analyst calculates the following activity and liquidity ratios for a company. Activity is nothing but related to turnover, and liquidity is nothing but related to current ratio, quick ratio, and cash ratio. So they are asking the relationship among ratios. There are 3 years given to you: 2006, 7, 8, and liquidity ratios in form of current and quick ratio, and days of inventory, that means stock conversion period, and days sales outstanding, debt collection period. Both are given to you. They're asking, determine what the analyst should infer from these ratios taken together. Let's understand. Current. So can you write your comments by seeing these ratios, what is happening and how it is happening? Hello. Okay, let's understand what the question says. The current ratio, you can see current ratio from 2006 to 2007 and 2007 to 2008 has increased over the period. What happened to quick ratio? Quick ratio has decreased, right? This could result from, see, current ratio has all the types of current assets, but quick ratio doesn't have inventory, right? So we have removed inventory from all this current assets in the numerator while calculating the quick ratio. So the quick ratio is decreasing because this could result from inventories increasing or from current assets other than inventories decreasing. See, if the inventory value would have been high in second year and third year, okay, please understand what I'm saying. If the inventory values would have been very high in the second year and third year, and if you are removing a major amount blocked asset, that means lot of amount is blocked in inventory. If such kind of assets you are removing from the numerator while calculating quick ratio, you would see a greater fall on quick ratio here. Please tell me, did you understand?
Yes, sir.
Yes.
Because if very high amount of inventory is there, if you remove that, definitely a very a lot of amount would be removed from the numerator of this current ratio. If you remove inventory from current assets, not current ratio, sorry, current assets. If you remove inventory from current assets, you get quick assets. So very high amount of inventories if are available here. And if you remove that major chunk, let's say if I give you imaginary figures, let's say my current liability is 1 lakh in all the cases. Current assets are 1.2 lakhs, 1.5 by 1 lakh, 2 lakh by 1 lakh, let's say. So now here no issues, but here 0.7 I have to remove. Here I have to remove 1.5. So lot of inventory, right? I'm removing bigger amounts. Then I'm getting a lower quick ratios. So that can be this could result from increasing inventories or from current assets other than, sorry, what was that? Yeah, the current ratio has increased over this period while quick ratio has decreased. This could result from inventories increasing. Yeah, the inventories are increasing, right? That means higher amount of inventories you are removing while calculating quick ratio. That's the reason why you are seeing fall in quick ratio. Point number one. The increase in days of inventory on hand suggests increasing inventories explain the opposing trend in current and quick ratio. So we have discussed that one. Maybe very higher amount of inventories are available in this in the numerator of current ratio, that is current assets, and we remove higher amount from that, it will show very smaller amounts of quick assets in the numerator of quick ratio. Henceforth, the ratio may be decreasing. Point number two. We are speaking about decrease of we are seeing there is an increase in number of days of inventory. Stock conversion period is increasing every time. Okay, you want you want more number of days to convert your stock into cash, or less number of days to convert your stock into cash? Less number of days. That is only possible if the inventory turnover ratio is higher. So here the inventory turnover ratio must have been decreasing, right? So the decrease in days sales outstanding indicates that company has been collecting cash from customers sooner than it had been in the past. Taken together, this ratio suggests company may be accelerating its collections, make up for a drain on cash from poor inventory management. Okay, so what is happening here? Is happening here. So you see the days sales outstanding. Days sales outstanding is nothing but debt collection period. It is decreasing every time. When debt collection period is decreasing, it is good sign for the company. That shows the formula for debt days sales outstanding is what? 365 days in a year by data's turnover ratio. If your data's turnover ratio is higher, your debt collection period will be less. Okay, let's say 365 by 20, 365 by 10. Here you are collecting in 36.5 days. Here you are collecting in almost, let's say, 18 days. So higher the ratio, less number of days. So it is a good sign. You are collecting your amounts much more faster than your customers, right? So this is proof. And inventory, we can see as it was evident, our current ratio was high every year. That shows inventory is high in the second and third year. That means lot of amount is blocked in inventory. Lot of amount is blocked in inventory. What's the formula for days of inventory? 365 days divided by stock turnover ratio. So a higher stock turnover ratio means lower day sales of inventory. So if the stock turnover ratio is more, you'll be having less what? Debt collection, stock collection, stock conversion period. Please tell me yes or no.
Yes, sir.
But what is happening? The stock collection period is increasing. That means the stock turnover ratio must have been less. Why the stock turnover ratio will be less? If your inventory value is high in the denominator. What is the formula for stock turnover ratio? COGS by average inventory. So you can see here the inventories are more, right? Because you see current ratio is increasing in second year and third year. That is because of higher amount of inventory. That means lot of inventory is kept in the business or money is blocked in the inventory and you are not able to sell that inventory. That will increase the value of inventory and your denominator will be high. If your denominator is high, your ratio is less. If your ratio is less, the stock conversion period will be high. That is not good for the business. That means you're taking more time to collect your money, more time to convert your stock into cash. Please tell me yes or no.
Yes, sir.
That's what. Okay. This is what is the understanding. Using ratios to evaluate a company. So this is what is the topic in front of you, and this is the last topic of this particular area, and then we can enter into DuPont analysis. Using ratios to evaluate a company, an analyst is comparing the values of several ratios for the current year to their prior year values. The current industry average values. So current industry, see, if at all I say Maruti Suzuki is a firm. What is that? It's a firm and it's a part of car industry in which many firms exist, like Honda. Maruti Suzuki is also a part. Then I have what we say the name, Volkswagen. Any more company you can say? Yes. Don't you remember Hyundai? So there are 4 companies or firms. These are a part of car industry. Okay. So now an analyst is comparing the value of several ratios for the current year to their prior year values. So current year ratio, whatever you are seeing, current ratio, total asset turnover ratio, debt to equity, return on common equity, net profit margin, they're comparing with the previous years and also with the industry average. These selected ratio values are shown in the following table. Now, what are they asking? This question I'm giving you as a homework. Discuss how these ratios compare with company's performance last year and with the industry performance. So, without seeing the answer, you have to give your suggestions, as I have given you a very strong and deeper analysis of this particular question by comparing the ratios of the current year with the previous years. In the same way, you have to compare the current year ratio with the previous year and also current year ratio of the company with the industry average, and you have to give your interpretation for that. Come on, tell me yes or no. Will you do this?
Yes, sir.
Isha,
Yes,
Isha,
sir.
you have a good idea about this because you have done this in FR paper of ACCA. Bhargav, will you be able to do this? You want the explanation?
No, sir, I'll do it.
I want a concrete answer and shouldn't be seeing the answer, and you should write and send me the answer as a screenshot on my phone. Okay?
Okay, sir.
Yeah, then I'll check and tell you what the answer is. So there are certain quiz questions. I will like you to do these quiz questions as homework. Now you will say everything is a homework in like in our class. How come? See, you have done ratios. Right now, I have explained every ratio to you. You should be reading properly and attempting the questions. Now, meant to be solved by the students. Next topic comes DuPont analysis. DuPont analysis tells that if you want to find out ROE, the formula for ROE is net income by average equity. Yes, we understand. But you can also break this formula into 2 formulas. That is called two-way DuPont. You can break this formula of ROE into 3 formulas. That is three-way DuPont. And you can also break this formula of return on equity into 5 formulas. That is 5-way DuPont. Okay. How it goes? We will not just understand with formulas. We will understand with the help of concept. Please try to understand the concept behind this. Now, see, return on equity. So you have bought the shares of the company and provided capital to company, right? And at the end, what you want to know is if you are investing $1, how many cents you are making out of it. In our examples, usually we have seen 10 cents. And also we know that we can compare this with the previous year performance and see whether current year performance is good or not. Coming to two-way DuPont. See, you as an investor will invest your money. Come on, tell me yes or no. Yes, you will be investing your money, right?
Yes, sir.
So that is in the form of equity. What will company do with those funding what you have provided to company in form of equity? Whatever the funding or whatever the finance or whatever the capital you have provided to company, what will company do with that? The usual answer would be company will like use that money for generating revenue, but that's the end case. Before generating revenue, they have to do the production if it's a manufacturing company, and that is also a secondary case. First and foremost, they have to purchase assets for the company. What they have to do? They have to purchase assets for the company. So here is the equity what you have provided to company. With this equity, company is going to buy the assets. What assets? Plant and machinery, building, land, okay, all kind of assets which are required to do the manufacturing. And whatever these assets the company has utilized, what is company going to do? First, you have provided equity to the company, the funding. With that funding, they have bought assets. With the help of these assets, they're going to manufacture and generate revenues. Okay, from revenue, they're going to generate profits. Am I right? That is net income. So what is common between what is the common thing here? When I from the perspective of equity and net income, assets. Why? From equity, what company got? Company purchase assets, and from assets, what company is trying to do? Generate income. Please tell me yes or no.
Yes, sir.
So net income by assets can be termed as what? Return on assets, correct? That is what you are seeing here, return on assets. And assets by equity, that means financial leverage. What we want to see, if company has assets of 10 lakhs and company has an equity of 5 lakhs, that means 50% funding from equity and 50% funding from debt finance. That is financial leverage. So ROA into financial leverage can also give you ROE. Understood? So here these two would be cancelled and the formula is net income by average total equity. Next, let's go for three-way DuPont. See, we have provided the funding to company in form of equity. With this funding, company has bought assets, okay, plant, machinery, building, etc., and started production process. Whatever they have produced, they have like sold that to public and generated revenue. And from this revenue, they want to know what is their profits, net income. Okay, so there are some things you can understand here. Between equity and revenue, assets is common, and between assets and net income, revenue is common. So like what we will do is, assets by equity is financial leverage, revenue by assets is asset turnover, and net income by revenue is net profit margin. So if we multiply these three ratios, then also you're going to get ROE, because this will be cancelled, the common thing. This will be cancelled, the common thing. Okay, if these two are removed, the ultimate thing is net income by equity. Come on, tell me yes or no. Did you understand?
Yes, sir.
Yeah.
Yes, sir.
Do this question fast. We'll go for five point DuPont.
On top, I didn't write them down.
You want to write this what have I explained here?
It's okay, sir. I'll take a screenshot.
Okay, no problem. Take your time. No issues.
Done, sir.
Yeah. Do this. Once done, tell me. Just a second. Yeah, what's the answer?
So it's
Hello.
17.3 times for all.
How come? First of all, you try to find out the normal ROE. What's the formula for ROE? Net income by average equity. They did it. You can do that with the help of DuPont as well. How? Net income by revenue is net profit margin. Revenue by assets, average assets is what? Asset turnover. And one more is what you have? Asset turnover, net profit margin. And one more is what? Financial leverage, right? Average assets by equity. Come on, tell me.
Yes, sir.
Right, this is for the last year search.
What last year?
No, wait. No,
The question is clearly saying for which year you need to do.
no, so for all 3 years.
That's what. Finished? Did you do this? Shall we move forward?
Sir, I didn't understand the concept.
I didn't get, sorry.
Sir, I didn't understand the concept because when we do it anyway, like you said, it is getting cancelled and at the end,
Sorry, I'm getting a call. Just a second, just a second, just a second. Sorry, Bhargav, just a second. Yeah, you were saying something, Bhargav.
Sir,
Hello.
I was saying that I did not clearly understand this concept of viewpoint analysis.
What didn't you understand? If you can elaborate on that.
So, can you scroll up, sir? So here, like you explained that the numerator and denominators are getting cancelled. And
Sorry.
when we, like here you said, the numerator and the denominators are getting cancelled.
It will
At
get
the
cancelled
end,
because there is something common here. You are seeing, right?
yes, sir, I understood that concept that it is common and we are deriving it from that.
Yeah.
But when we solve the question,
Yeah.
answer is always coming same.
No, they have directly given you the answers here. You are not taking those. See, for example, let's say if at all I found this is the ROE they have found out for all the years individually, right?
Yes, sir.
But if I see net profit, net income by net, what is the first year you have 2003. So I'm
Yes.
taking 2003's figures. Okay, only 2003's figures.
Okay.
What is net income by revenue? 21.5 by 305. Can you tell me what is the answer for this?
It's 0.7%, sir.
Yeah.
7.0.
Net income by revenue is net profit margin, and then asset turnover. That is revenue by, I'll prove you, revenue by average assets, right?
Yes, sir.
Then average assets by average equity, correct? So
Yes.
either this one will be 7%, this one will be 1.33, this one will be 1.93, correct or wrong?
Yes, sir.
If you multiply that, you're going to get 18.1. Instead of that, you do one thing, boss, cancel this. It's again 21.5, 21.5 by 119. The answer is 18.1. What's the big deal?
Sir, I got that one. Then the next answer that we are doing, no, viewpoint. Those are not answers.
What? Can you multiply this 3?
Okay,
7%.
sir. I got the answers.
Yeah. Now what's the doubt?
I know, sir. It's clear now. It's clear.
Maybe somewhere you got confused.
No, sir.
Am I-
The viewpoint is written down. No, I thought those were also answers, and it was not really matching.
Yeah. See, they have done normally, and they have done with with respect to DuPont, and they are trying to show you that both are giving the same answers only. That's it.
Yes.
Okay. Almost done. Five point DuPont. Again, lengthy concept. Can we take this tomorrow? We'll take this tomorrow. Okay. So tomorrow is the end of this chapter. Done. Okay. Nothing left over. And tomorrow also TVM. Okay. We will finish this. Why? Today only let's wind up. We'll not skip for tomorrow. So we are doing a extended DuPont analysis and it's like very simple. I'll explain you the formula. You have to do the question. See, you are well aware of first investors will invest in the company equity, right? With this equity, what's company going to buy? Assets. What is company going to do with these assets? They're going to generate. Come on, tell me.
Revenue.
Revenue. From revenue, whatever they have got, they are going to generate what? Operating income, correct or wrong?
Yes, sir.
From operating income, what they are going to pay?
Interest.
After paying interest, what are they going to get?
Profit after tax.
PBT.
Okay.
From PBT, what they are going to remove?
Tax.
Then after that, what are they going to get?
Profit of the net income.
Net income. So at the end, ultimately it is with investment of equity, we are going to generate net income only, right?
Yes.
What are common will all be removed. That means for these two assets is common, for these two operating income is common, for these two interest is common, for these two PBT is common, for these two tax is common, correct or wrong? That means, let's say if you don't take that as common, I'm trying to explain you the concept here. The concept goes in this way. Bhargav, are you following?
Yes, sir.
You already knew about financial leverage, right? That is average total assets by average total equity. Am I right? It was a part of 3 point DuPont, right? This was there in 3 point DuPont. This was there in 3 point DuPont. This was there in 3 point. This was not there. Only you had net income by sales. See, what you saw in 3 point DuPont was net profit margin into asset turnover into financial leverage. Same financial leverage is there, same asset turnover is there, but net profit margin has been broken down because net profit is the final profit. Company has two obligations to settle before reaching to net profit. That is, one is the interest burden and one is the tax burden. Correct or wrong? Yes or no in chorus?
Yes, sir.
Yes or no? You have to settle this down. That's it. So what we are doing is we can find out the ROE in this way also. Whatever the equity you have invested as an investor, company is going to buy assets. With those assets, company is going to generate revenue. Okay, whatever revenues we got from that, if we remove the direct expenses, whatever the expenses or manufacturing expenses, etc., and operating and administration expenses, we are going to get EBIT, that is operating income. Correct or wrong? Yes. Hello.
Yes, sir.
Bhargav, yes or no?
Yes, sir.
So I'll write it neatly here. Equity investment has been done. After investing this money in the company, company is going to buy assets, okay, in form of plant and machinery, etc. So total assets, let's say. From these assets, they are going to start the manufacturing process, or they're going to produce goods and they're going to sell it. That's called revenue generation. After generating revenues, they are going to reach to operating profit, which is called as EBIT. That's why we are speaking about EBIT margin. And after getting EBIT, they're going to settle, they're going to pay the interest and tax, and they're going to reach to net income. That's it. So again, net income by equity is your ROE. So financial leverage, total asset turnover, EBIT margin is operating profit margin, interest burden is what we are going to pay the interest. And the formula for interest burden is EBT by EBIT. That means interest will be paid here. And again, the formula for tax burden. What's the formula for tax burden they have given? Net income by EBT. Okay. So when you take this entire formula and multiply, you get the 5-way DuPont. So tax burden is net income by EBT. Interest burden is EBIT by EBT by EBIT. This is tax burden. Okay, because from EBT you remove tax, you got net income. From EBIT you removed interest, you got EBT. Okay, if you want to remove, you have to divide or subtract. This is the only way, common sense. So tax burden, interest burden, operating profit margin, asset turnover, and then financial leverage. All this, if you club, you see, you're going to cancel this two, 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 you're going to get net income by average equity. That's ROE. Okay, come on to this question. So this is a big question you have to do. I'm giving this as a homework. Finish this off. See, there can be ratios, okay, which we will continue this tomorrow. It will take some good time. Tomorrow we'll take 15-minute session and finish this, and we'll also jump into TVM and we will close that tomorrow. Okay. Please do the homework and show me. You have to write that homework question which I've given, and also this question which I've given to you. These two you have to do as a homework. Yes, come on. Hello.
Yes, sir.
All of you. Bhargav,
Yes, sir.
you have to finish this. Okay.
Okay.
Okay. Okay. Fine. Thank you.
Sir,
Yeah. Tell me.
sir, what is the point of doing this DuPont analysis?
viewpoint is giving you a very detailed idea of finding out return on equity. See, for all students who are doing this, like who are finding out ROE, it is from the perspective of an investor who has invested money in the company in form of equity, and he wants to know what is the return he has generated. That means if I have invested $1, I want to know how many cents I have made. But is that the only thing? No. Someone wants to, if someone wants to know the breakup of finding out ROE, he can get a very clear picture and a detailed idea of how the money is utilized. Correct? You want to know how your money is getting utilized in the company in form of equity?
Yes, sir.
That's what. So if you want to know that, you have all the details here. My equity, whatever I have invested, has been utilized for buying assets. Why I bought assets? To generate revenue, because whatever the assets I bought, I'm utilizing them for production process. I'm converting my input into output by using machine, right? I have a factory, etc. Yes or no?
Yes, sir.
So whatever the investment I have done as an investor, that investment has been utilized in this way. First, company has bought assets. With those assets, they have started the production process. Whatever they have produced, they have sold to people. They have generated revenue. But revenue is not the thing which I'm looking for. I'm looking for my final profits. But before that, there's a long journey to be covered up. From revenue, I'm removing COGS and operating and administration expenses. I'm getting operating income, that is EBIT. From that, I'm settling certain obligations, that is paying the interest to debt holders and also paying tax to the government of India or government of United States, whatever. And then finally, what I'm getting is net income. Did you get an idea with this or not? Did
Yes,
you
sir.
get an idea? That's what people want to know that. So this ratio gives them a very detailed idea about this. That's it. Any more doubts?
No, sir.
Yeah. So please go through this, do the homework and report me tomorrow. Thank you.
Thank you, sir.
Thank you all of you. Thank you. Yeah.